the easiest high-profit setup in technical analysis. Capitalize on the corrective phase, catching the C wave.
Welcome back, everyone, to day 12 of our Time and Cycle Mastery series. I am absolutely thrilled about today's explainer because we're zooming in on a highly actionable concept within Elliott Wave theory that is literally going to transform how you look at market pullbacks. Seriously, if you've ever felt like you're just, guessing when to buy a dip, this is the session that changes everything. I want to hit you right out of the gate with a pretty bold statement. A lot of seasoned traders consider catching the C wave to be the easiest high-profit setup in all of technical analysis. Crazy, right? But why? Well, because it systematically removes the guesswork. You're no longer out there randomly trying to catch falling knives. Instead, you're using basic Elliott Wave elements as a rigorous method of pattern recognition to find a precise, mathematically backed entry. Okay, let's dive into this. Here is our quick roadmap for today. First, we'll cover the high-profit C wave. Then, rejoining impulsive trends. Third, navigating corrective markets. Fourth, adding Fibonacci precision. And finally, pulling it all together into the complete trading strategy. All right, part one, the high-profit C wave. So, as a quick refresher on Elliott Wave theory, you don't actually need to predict every single wave to make money. You really just need to know exactly when to enter. Think about this definition for a second. A C wave pattern is simply the end form of an ABC correction. It signals the optimal moment to enter the market. Your single overriding goal as a trader using this method is actually to do nothing for most of the time. As the old saying goes, trading is 90% waiting and 10% execution. You have to stay completely out of the market until the specific ABC pattern is just about to end. It is all about calculated patience. To keep us disciplined, our sources outline these golden rules for the setup. First up, like we just talked about, stay out until that C wave ends. Second, in a classic structure, wave 2 absolutely cannot end beyond the start of wave 1, meaning it can't retrace more than 100%. Third, wave 3 cannot be the shortest wave among the impulse waves. Next, and I really want to emphasize this one, only trade the most well-defined patterns. If the chart looks like a total mess, just don't take the trade. Save your capital for a clear textbook situation. And finally, your profit targets are going to depend entirely on the broader market context. Let's move to part 2 and see how this builds, rejoining impulsive trends. And this brilliantly illustrates what happens when the primary trend is moving upward in a 5-wave structure. 1, 2, 3, 4, 5. Notice those buy points mapped out right at the end of the pullbacks? In an impulsive market, the wave 2 and wave 4 corrections typically take the shape of an ABC pattern. The very bottom of that C is your trigger. That's what gives you the perfect low-risk signal to buy in and ride the main trend up. In this specific environment, you want to trend trade and basically just hold that position until the entire macro impulse wave finally exhausts itself. But, the market isn't always blasting off in a straight line. So, part 3, navigating corrective markets. Now, what's really interesting about this environment is how the exit strategy shifts when things get choppy and overlapping. You're actually still executing your buy at the exact same trigger, the absolute end of a wave C. However, your profit objective changes completely. Instead of holding for some massive wave 5, you're going to hold your trade through the subsequent ABC pattern. Once that next ABC completes, boom, that is your signal to take profits, and you can even look to reverse your position to trade right back the other way. Let's put them side by side, because what you absolutely need to take away from this is that confusing your market environment will wreck your profit targets. For the impulsive strategy, you are trend trading. You add to your positions at the end of wave 2 and 4 and hold until the impulse ends, period. But for the corrective strategy, you still enter at the end of wave C, but you must wait until the completion of the next ABC pattern before taking profits. Distinct environments demand distinct exits. It's as simple as that. Moving right along to part 4, adding Fibonacci precision. This is the secret weapon. Knowing the visual shape is fantastic, right? But how do we know exactly where it's going to terminate? 0.618 or 61.8%. Burn this Fibonacci ratio into your memory. When we're looking at that first major pullback in a new trend, wave 2, it typically retraces deep into the prior move. Specifically, it loves to land right in that 0.5 to 0.618 golden zone of wave 1. Okay, let's slow down for a second and make this highly practical. Here is exactly how you measure it in your charting software. Step 1, select your Fibonacci retracement tool, anchor it at the exact low of wave 1, and drag it all the way up to the high of wave 1. Step 2, Watch the subsequent ABC pullback unfold and target your C wave entry right when it dips into that zero point 0.5 to 0.618 zone. When the visual pattern meets this mathematical zone, your analysis becomes incredibly strong. Next up, we have 0.382, or 38.2%. This is your absolute crucial ratio for Wave 4. Remember, Wave 4 pullbacks are usually much more shallow than Wave 2 pullbacks. Why? Because the underlying market momentum is incredibly strong at this point in the cycle. So the mechanics are slightly different here. To find the end of the Wave 4 C wave, step 1, anchor your Fibonacci tool from the low of Wave 3 to the high of Wave 3. And step 2, target your C wave entry right around that 0.382 retracement level. Now look, markets aren't always to the tick perfect, we know that. But layering these specific percentage pullbacks on top of your wave counts, it drastically increases your hit rate. And just briefly, I want to introduce a Fibonacci extension ratio, 1.618. You might be wondering, why does all this precise entry work even matter? Well, because if you successfully catch the end of a Wave 2 pullback, your next target, Wave 3, commonly extends 1.618 times the entire length of Wave 1. That is a massive, highly profitable move. And getting the C wave entry right is your golden ticket to ride it. All right, let's bring it all home. Part 5, the complete trading strategy. So the crucial point is, if you want to master this, follow this insider's blueprint checklist. First, identify the broader context. Is the market impulsive or corrective? That defines your exit. Second, sit on your hands and wait patiently for that clear ABC pattern to develop. Third, anchor your Fibonacci tool to measure the preceding wave. Fourth, demand confluence. Look for that C wave to end right at the 0.618 level for a Wave 2 or the 0.382 level for a Wave 4. Finally, when those signals align, you nail the exact entry as soon as that Wave C completes. We have covered some incredibly powerful ground today in day 12 of our series. You now know what many consider the single easiest high-profit setup in technical analysis. You know the visual ABC structure, you've got the precise Fibonacci measurements to completely remove the guesswork. So the only question left to ask yourself as you open up your charts today is, are you ready to catch your first C wave?